Bond investors continuing to question the longer-term safety of U.S. Treasuries, buying up the front end of the curve and selling off the longer-term Treasury bonds. You're seeing that play out here today with the 10-year and the 30-year moving higher right now. This comes after President Trump called on Fed Chair Jay Powell to cut interest rates amid the volatility. Where can investors seek safety within Treasuries? Here with more, we've got Cooper Howard, who's the fixed income strategist at Schwab Center for Financial Research. Cooper, good to see you. First, I just want to get your overall view of the bond market right now.
It's great to be back, so thank you very much. I think the overall view of the bond market is a lot of uncertainty and a fair amount of volatility. And I think what we're seeing in terms of the moves in yields today is really kind of a microcosm, Brad, of what we've seen in the move in yields over the past couple of weeks, if you will. And usually when you see a significant sell-off in the equity market like we're having today, kind of drives a little bit of a flight to quality in the fixed income market. You would see higher prices, lower yields. Obviously, that's not what we're seeing today. So I think really what it's showing is that a lot of foreign investors are diversifying away from their fixed income investments in the US. Now, in terms of the safety of US Treasuries, we still believe they're backed by the full faith and credit of the US government. That doesn't change things. So we still do believe that there's a high likelihood that they're going to pay when they're coming due. But given a lot of the uncertainty, given a lot of the concerns over tariffs and trade policy, what we're really seeing is just a lot of foreign investors diversifying their assets away from US dollar investments like treasuries and moving to other investments such as maybe the euro, the yen, things of that nature.
And so that starts to get me to my next question. What areas of the bond market look attractive right now?
Yeah, with volatility, with kind of uncertainty, that does create some opportunities. And there are two really pieces of parts of the market that I think are fairly attractive right now. The first is the municipal bond market. So, Brad, these are bonds that are issued by cities, states, local governments. Usually they're attractive to higher net worth investors because they pay interest income that's exempt from federal income taxes. If you look at the yields relative to other alternatives, we think that they're very attractive at these levels. One of the metrics that we'll commonly follow is the muni to treasury ratio, which looks at what is the yield on a AAA rated municipal bond. That's the highest credit quality relative to that of a treasury. That's above its 3-year average right now. If you also look at the average tax rate that would make the after-tax yield for a municipal bond equal to that of a corporate bond, that's about 22%, 25%, depending on where on the yield curve you look. So again, that's a low average tax rate compared to where we have been historically. So we do think municipal bonds make sense for those who are in higher tax brackets. Right. Now, for other investors who might be investing in something like a tax sheltered account, say like an IRA, or not in those top tax brackets, we think maybe the investment grade corporate bond market could be an area of opportunity. We're a little bit more cautious on high yield investment or high yield corporate bonds, Brad. The reason being is that the additional compensation, that spread that you're receiving for investing in those bonds, is still relatively low, even though it has moved up recently.
And so let's say someone is not currently invested at all in the bond market. You say the why is critical to start investing. So why? Why do you want to get into the bond market?
That is, the why is critical. And it's akin to, say, if you were planning a road trip, well, where is your destination? That's the critical point of it. And that's applicable to the fixed income markets as well. So really what we like to look at is there's kind of 3 reasons why you should invest in bonds. They can overlap, so they oftentimes do overlap. We like income, diversification, and then capital preservation. And if you define what that goal is, then that's really going to lead you towards what types of bonds you should be investing in, and then also where on the yield curve. And that's just another fancy way or fixed income jargon way of saying how far out in maturity should you be investing.
And so the next one, what about income? What if you're investing for diversification, but also trying to make sure that you're looking across what the income proponent looks like as a part of all this?
Yeah, so that's one that we oftentimes find with a lot of our investors, especially those who are in retirement, are geared more towards an income bent. What we suggest is usually about the bulk of your portfolio should be in higher rated investments. Think things like US Treasuries, investment grade corporate bonds, investment grade municipal bonds. And then from there, if you're a little bit more of a risky investor, Brad, we suggest no more than 20% of your fixed income portfolio into aggressive income sectors. Those are going to be things like high yield corporate bonds, emerging markets, preferred securities, tends to be that they have a little bit more volatility. They're also more correlated. They move more closely with the direction of equities. So you're not getting as great of diversification benefits, but you are boosting up that overall yield in a portfolio. So we think that, again, stick the bulk of your portfolio or stick to the bulk of your portfolio in highly rated investments, and then consider adding some of those aggressive income sectors on top of that.
How does that change depending upon what generation or age group you find yourself in? And of course, what I'm alluding to is how close you are perhaps to retirement and ultimately need to have a little bit more of a stable strategy to your portfolio versus one that is taking on more risk.
Yeah, that's a great question. And I think what you want to look at it from that lens is you want to look at it from the lens of what is your risk tolerance as well as what is your risk capacity. So those are two separate things. So risk tolerance would be something like if I open my account and I see that it's negative for the day, how does that make me feel in my stomach? Do I get a big stomach drop in that sense? Risk capacity is how much can I afford to experience a loss in my portfolio before it would begin to create kind of issues with my retirement income spending or other parts of my regular life. So when it comes to risk capacity, what we generally suggest is have enough money to support your spending for 1 year and keep that in something that's relatively liquid, relatively safe, something like a cash account, a savings account, money market funds, for example. And then from there, the next 2 to 4 years of investment should be in high credit quality, short-term investments. That way, even if you experience a downturn in the market, you have enough money to support current spending in terms of your short-term allocation and your cash allocation. And then you begin to build out the rest of your bond portfolio, depending on both what your risk tolerance is and then your capacity.
And just lastly, if you're looking to invest in bonds for capital preservation, how do you go about that kind of decision tree?
Yeah, that's another very good one and another very common investment decision or investment goal that we find our clients geared towards. And I think one of the things to look towards that is identify what is the need of that money. So for example, if you have a college kid who needs to pay their tuition in 2 years and well, that bill is going to come due in 2 years, that's going to guide you towards probably a 2-year investment. Again, we would suggest stay with something that's highly rated because the chances of default, and that's just a fancy term of saying how likely are you going to receive your principal plus the interest income that you're expected to receive, the chances of default are relatively low the higher rated investments you go with. So if that's something of where you're more geared towards capital preservation, consider something like a US Treasury bond, a CD, or again, very highly rated corporate or municipal bonds, depending on your risk tolerance.